Hey folks, thank you so much for coming out this evening. My name is Dallin Schultz. I'm the president at REV Equity Group, and this is an opportunity and a vehicle that we've been working on for the last 9 months. So my team and I are really excited to bring this and introduce it to you and look forward to working with those of you on this call that align with our interest and understand what we're accomplishing here. So a couple of ground rules before we go ahead and get started. We are not CPAs, we are not attorneys. So consult with your attorneys. If you're looking for tax advice, consult with your CPAs. We are here to present an opportunity to you, but it's still up to you to do your due diligence. Now, with that being said, please ask us questions. We want you to ask questions so that you can feel comfortable moving forward with this opportunity. Our goal for this webinar is to help you understand the benefits of a fund and why we've decided to set up a fund. We're not going to go through slide by slide, but we do anticipate questions coming up. Most of your questions will likely be answered on this webinar. If not, again, reach out to my team and I so we can go ahead and give you that information that you need so you can make an educated decision to move forward. So as I mentioned, this is an opportunity we've been working on for over 9 months. My team and I got together back in September of last year for 3 days up in the mountains at a cabin to formulate and put together a new option, a new way to invest in real estate. Things are constantly changing. The market's shifting and interest rates are rising. We're all familiar with what's going on in the market around us today. So as we started recognizing these changes, we came together to talk about and discuss what is the next best move we could provide to our investors while still giving them opportunities to invest in real estate. And we're excited that after 9 months of discussion and research and connecting with incredible attorneys and accountants, we've brought together and launched and are now launching REV Equity Fund I. So before we get started into that though, I wanted to share with you and introduce the members of my team. I might be the face and the mustache of REV Equity Group. Some of you have probably seen me around social media and emails doing a lot of education and content because that's really important to us. But I absolutely could not have done this without my team. So what I'd like to do is just briefly introduce them to you. So Jim Hodges is our Director of Operations. He oversees all the compliance and makes sure that we're compliant with the SEC and making sure everything, all the T's are crossed, I's are dotted, and to make sure everything is working in place. Lacey is our Director of Marketing. All the emails, all the social media, all the videos, our branding has all been her, and it's been incredible to see what she's been able to do with us over the last couple of years. Paul Karchner is our Director of Project Integration. When you're working with funds, when you're working with real estate syndications, there are a ton of moving parts. So Paul really focuses on building out our systems, our standard operating procedures, and creating a very good and efficient workflow so that we can all be firing on the same cylinders and create an overall better experience for our team and the people that choose to partner with us. Hillary is our administrative assistant. She doesn't just help me, she helps everyone on the team, and she does such an incredible job. Some of you have had experience with her already, and she's very on top and very good at communicating, which is important to us here at REV, that maintaining that open line of communication. William Hahn is our analyst and underwriter. This dude is a wizard in Excel and financial modeling. So he's been an integral part for us in identifying the properties that the fund will be participating in. So we're really excited to be working with him. And then Aaron Wyas is our investor relations manager. Aaron is that direct contact, that direct connection to all those that decide to work with us or are considering to work with us. So again, I mentioned communication. That's very important to us. So Aaron is there to ensure and make sure that everything is, your questions are answered and that you're kept in the loop with all the communication, what's going on with the projects. So we also have 2 other indirect team members, if you will, that I'd like to share. Number one being Premier Law Group. They are a top-rated securities firm in the country that we've partnered with to put together and structure this deal for you. Then the other one is Justin Jensen at Morrison Clark Company. He's our CPA with extensive experience, knowledge, and years in the fund and real estate accounting space. So we're partnering with him to oversee all of our accounting and fund management. So we're excited and looking forward to working with him. So again, I could not have done this without my team. If you choose and decide to work with us, you'll likely come in contact with almost everyone on our team at some point. So I wanted to introduce their faces so that you were familiar with who they are. So let's go ahead and get started. Listen, you're here, you're listening to this webinar for everyone probably has a different reason, right? You're interested in getting involved in real estate, specifically apartments. Maybe you're just here to learn about opportunities and to educate yourself. So again, I appreciate you being here. Here's the deal. Life throws curveballs. You got to expect the unexpected, right? Some of us might have lost a job in the past. Some of us might have lost a life partner that was the breadwinner. Some of us might just be looking to grow and preserve our wealth so that we can give more freely and abundantly of our time and wealth. People get involved in investing, and specifically real estate investing, for various reasons. Maybe you're just looking to save money on taxes. I don't know, okay? The point is, you're all here for a reason. You're watching this webinar for a reason. For me, that reason came very, very clear about 5 years ago. So I was working as a new grad nurse in the emergency room, and I got into a pretty bad soccer accident where my leg took the full force of a kick that was meant for the ball, and it went right into my shin, shattering it, breaking it. In this moment, part of the reason I got into the medical field was for that safety and security. That was important to me. My wife, my 2 kids were depending on me. And in that instant, I remember laying there in the hospital bed, scared. I've never been so financially fearful in my entire life. And it's because I failed to realize what would happen to me if I couldn't work. I knew other people were going to get sick and hurt, but what about me? And that really shifted something in my brain. And I said, something's got to change. Something's got to change. So that's really what jump-started my career into real estate. And over the last 5 years, we participated in over $60 million worth of real estate transactions. And we're looking to exponentially increase that year over year because of the relationships we've built, because of the experience we've gained. And at the end of the day, we just want to let people know that there's other options out there. Now, look, I understand that this opportunity might not be aligned with your goals, but you're here listening. And so what I hope to do is to convey to you the opportunity that we have. And if you have additional questions, let's get on a call and let's talk more. So when I got started in real estate, I started small. I didn't realize I could get into these large projects. And when I say large projects, I'm talking $20 million or more, 100+ unit communities. I didn't know that was even an option. And then I found out about it. And something inside of me clicked. And I was like, people need to know this. They need to know that you can participate in larger projects. And so I took it upon myself to educate as many people as I could about the opportunity. Even if it wasn't aligned with their goals and they weren't interested, I wanted them at minimum to know that it was an option. And what we're presenting to you tonight is a strong option that we hope to share in with you. Excuse me. Now, there was 3 things that really resonated with me as I started learning about multifamily investing. We're going to get into a few more things in our PowerPoint, in our presentation here in a second. But the 3 things that really made sense to me around multifamily, I'd like to share these with you, is number 1, the economies of scale. When you have more of something, it becomes more efficient, especially in the real estate space. So for example, you buy a single family home, tenant moves in, air conditioner breaks, water heater breaks, the tenant moves out, right? And it takes you a month or 2 to renovate it, turn it, and get somebody else in there. Kiss your cash flow goodbye. Kiss any potential income that you were expecting goodbye, because you got 1 unit. Now, if you were to be involved into a large property, we'll say 100 units, you have much more units to cover, to bring in income and to help cover expenses. It becomes a lot more efficient. So economies of scale, it made sense to me. Number two, it's a tangible asset. When you invest in real estate, it is a hard asset. You can touch it, you can see it, you can tour the property, you know, and can see specifically what your money is doing for you. For me, I like that. I like knowing and being able to see, I'm a very visual person, see where that money is working. Number three is the forced appreciation. And this is really what drove it home for me in regards to smaller real estate projects like a single family home. Forced appreciation. When you buy an apartment, you are buying a business. That business is valued based on how much income it generates. So as operators, we're able to go in and increase that income. We decrease the expenses and we exponentially increase the value of that property. Yes, the market still plays a role in the valuation of apartments, but the other aspect to that is how much income it generates. We have control of that. We as a group have control of that. And that's what just really hit the ball home for me in multifamily real estate, because there is an aspect of control that you could force the appreciation that you can't. In the stock market, you can't do it. In single family home, you can't force the value of things in other asset classes. It's very dependent in just the market, what the market's willing to pay for that. So as we started recognizing the shift in the market as a team, we came together and we asked, what can we provide to create the best vehicle that makes sense for us and our investors? And the answer was this fund. And more specifically, it's called a fund of funds. And we'll get in a little bit more into that. So what I like to do now is actually jump in to the opportunity. So REV Equity Fund I, this is a 506c offering open to accredited investors only. We're going to talk about that in just a minute. This is a high-level overview. A lot of these things we'll be touching on further on in the presentation here. So we actually have three classes of investor based on how much people want to invest. And there's higher returns projected for the more capital that is invested. This is going to be a diversified nationwide portfolio. We are not focusing on a single market. We're going to diversify it across multiple markets. And again, we'll talk about this a little bit more. 5 to 7 year commitment. That is our projection of how long this fund will be open for. Traditionally, you could expect 3 to 5 years, but with the market shifting, we want to set that expectation of 5 to 7 years. Here's the deal though. If deals are selling sooner than 5 years and we're still hitting projected returns, then we'll sell. So we're not locked into that 5 to 7 years, but we just want to set realistic expectations for you as the investor. Now, we're projecting conservatively 10 to 16% average annualized return. Again, this will depend on what class, what level of investor you are. Again, this is a 506c offering open to accredited investors only. We are looking to raise $10 million and to deploy that in anywhere from 4 to 8 deals in multiple markets with multiple operators. So why invest in multifamily? I love this chart. I share it in all the education that we've done. I share it quite often. Multifamily has proven and historically been one of the most recession resilient asset classes. So this is a chart here back from the 2008-2009 recession put out by CBRE, one of the largest, if not the largest, commercial real estate firms in the country. So if you look on the left side of this chart, you'll see a red, blue, gold, and gray bar. So this is the rent decline from the recession. So back in 08-09, when rent started compressing, what areas got hit the hardest? Now, again, this is looking at commercial real estate, different commercial real estate asset classes. If you look at multifamily dropped 7.9%, followed by retail, and then office and industrial right behind it. So this shows that multifamily rents compressed the least, meaning that it was maintaining the highest strength out of these other asset classes. Now, if you look at to the right, you'll see again the red, blue, gold, and gray bars. And this is the rent growth past the prior peak. So this is up to 2018. So, and again, I'm sharing this information. I get that it's back from 2008, 2009, but you can't talk about real estate. You can't go on the news. You can't go on social media without people talking about recession. And we're here to show you that historically, multifamily has been one of the safest places to park capital and to grow and preserve wealth. So this chart on the right, if you look at the rent growth of multifamily, it supersedes all the other asset classes exponentially. And this is why, at the end of the day, you're providing a basic human need. You're providing shelter. And when done right with the right operators, you can very well improve the quality of life of those tenants and justify higher bits of rent. And so you can control that aspect of the investment process even more. So again, one of the reasons why we really believe in multifamily, there's more information on this in the pitch deck. Again, I mentioned we're gonna gloss over different things during this presentation. The pitch deck is gonna have much more of the information. And again, we're always available for a call. So why invest in multifamily? We talked about that. Okay. Our process at REV, and we share this and educate on everyone how to vet an opportunity. Most people start with looking at the deal itself, and that is a big no-no. That is a big no-no. So our process of vetting an opportunity, we first and foremost look at the operator. We look at the people that are running the deal. Then we look at the market. Then we look at the deal itself. And here's the reason. You can have a phenomenal deal with a bad operator, and they're going to drive that into the ground. Or you can have an okay deal with a phenomenal operations team, and they're going to crush it. They're going to kill that deal and can do very, very well with it. So this is the process that we go through in vetting the operators, vetting the markets, because we want to know, we want to be investing in strong markets with a lot of growth. And again, there's a slide on this I'll touch on, and then we look at the deal itself. So that's our vetting process. Now, when it comes to operators, we've spent more than 5 years traveling to conferences all over the country, connecting and verifying very effective partners, people that the fund will be participating with. So a lot more information on this in the pitch deck, but these were some main points that I wanted to share with you. So when we go through and vet operators, we have a 3-phase process. Number 1, they fill out an application. Number 2, we get on a Zoom call with the leadership team, not the managers, not the investor relations person. We get on with the leadership team and we ask additional questions. We get a feel of how they operate. We get to connect with them. They get to connect with us. Third step, we actually do a site visit. We go there and we visit them. And we actually did this just 2 weeks ago in Texas. We went to a market. We visited the operator. We connected with his team. We met his management company. We met all the leadership team. We toured some of their existing deals so we could see how they were managing, how they were doing their renovations. We did all of this. And it takes us a solid, at minimum, once we start the process, I'd say at minimum a month to go through our verification process for the people that we're going to partner with. And these are some of the things we look at. So track record, at minimum, our operators have to have taken 5 deals full cycle. Most of our operators have taken much more than that full cycle, meaning they bought a deal, they executed the business plan, and they sold it. That's important because we're really looking at their track record. Experience, we're looking for people that have more than 5 years of experience. And this one's big for us because if anyone got started in real estate in the last 2 or 3 years, everybody looked like a rock star. Everybody looked like that they knew what they were doing because the market was so strong, it was carrying a lot of these operators. But today, this year, those people are being weeded out because they made unwise decisions and choices a few years ago that are putting them and their investors in a pinch right now. So we look for 5+ years of experience in apartment management and asset management class. So they have to specifically have been doing these 100+ unit deals for the last 5 years. We're not looking for people that have a little bit of everything. We're looking for that expert asset manager in that multifamily deal. Management style is really important. How they make their decisions and their property, how do they manage their property managers? And most of our operators now actually have management in-house. They have that property management in-house, which we like because they can maintain a higher level of control of that asset. And then the financial stability. Do they have adequate cash reserves for the unknown? And this is huge for us right now. Number one question we're asking operators that we're partnering with right now is, have you ever done a capital call? Because if they have, that means that they didn't have adequate cash reserves to weather the unknown. And so far, all the operators that we've vetted and that we're partnering with have not, nor expect to do a capital call anytime in the near future. So they're very conservative with their underwriting and their approach, and they have enough cash reserves to weather any of the unknown. Communication is probably the number one for us. How are they communicating? How are they getting information over? That's super important. So on the right here, this is a summary of the operators that we've vetted so far. So collectively, they're managing over $3.2 billion of multifamily assets. Very strong leadership teams, combined over 99 assets with over 17,000 total apartment units. These are the types of people that this fund will be partnering with. So we're really excited to have vetted them and looking forward to working with them. So after you vet the opportunity, you want to look at the market. Again, I'm going to start cruising through these for the sake of time. Feel free to pause the webinar to look at the slides, or it is in your pitch deck. Okay. Market criteria, the five top things that we look at before we invest in a market is the population growth, job growth, crime index, income, and home values. And these are some of the general numbers that we look for when we vet these markets. Again, we look at the operator, we want to make sure it's in a strong market because that adds more padding to the deal itself. And then when we go to vet the deal itself and underwrite the deal, we add additional padding in here. So this is our conservative approach in vetting opportunities. We make sure there's a strong leadership team. We make sure that the market is definitely in the favor of the asset and for the investors. And then we look at the deal itself. So what types of properties are we looking at? So we have Class B to A+ properties. These are typically built 1980s or newer. And the reason we stay north of 1980 is because there's less unknown. Construction is usually pretty solid, and you don't have any major renovations or surprises most of the time. So this is where we look at these B and A class properties. We're looking for 80 units or more because, again, economies of scale. It's a lot more efficient to manage these types of deals when there's more units. You can put property management on site. You can have a maintenance guy. You can have a leasing agent. A lot more efficient. General expense ratio between 30 to 50%. This is absolutely going to vary per market. That's why we put a range on here. It's also going to vary based on the age of the asset and what type of work is being done. But again, some general rules of thumb, so you're aware of the types of properties that we're looking at. And are the renovated rents in line with the market rate? So we do some rent comps and we make sure that that business plan can be executed. And again, the conservative underwriting. These are all very, very important. So these are two of our most recent investments. The Henriette Jones Road on the left. This one we closed on last December, and that was actually built in 2013. Beautiful asset. And then the one on the right, the Henriette Rosenberg, this one was closed on in September of last year. And that one was built, I believe, 2008. And you're at 184 units for that one. So these are the types of projects that we've already participated in and will continue to participate in. In fact, we've already got 3 deals pending, 3 deals where the operators are waiting for this launch because they know that we have investors that are ready and anxious to get their money working for them. So we're really excited to get into some of these new assets as soon as next week, once investors' capital starts coming in and they start funding. So strategy. The fund strategy here, a big part of it is leverage. And this is what some investors fail to understand when working with a fund. When we're investing $1 to $2 million for this fund, we're going to invest $1 to $2 million into multiple deals. When you're investing that much capital into a deal, you're able to negotiate with the operator, you're able to negotiate with the partner for a better return or better terms, because you're not placing 50,000, you're coming in with 1 to 2 million. So being able to leverage that fund will actually enable us to get better returns that will flow down to our investors. So that's what we're really excited about. Now the returns, we mentioned this earlier, we're conservatively projecting 10 to 16%. We've got another slide where we're going to dive a little bit more into this, so I'm not going to touch on it too much. This is a closed-ended fund. I think that's important to bring up. What a closed-ended fund is expect your investment to be illiquid. We treat it as illiquid. So it comes in 5 to 7 years, maybe sooner, maybe longer. It depends on what the market is doing. At the end of the day, our job is to grow and preserve your wealth. So whatever decisions that we and the partners decide to make is going to be in your best interest. Now with the closed-ended fund, the investments don't come in and we don't keep buying and selling multiple properties. As investments come in, we'll go out, we'll put it into a deal, and it stays in that deal until that deal sells. When that deal sells, the money flows right back to the investor. We're not reinvesting it with this fund. With that being said, we very likely will have other opportunities lined up. So if an investor wants to get that return back and put it into another deal, that option will be available. But that's what a closed-ended fund is. Okay, introductory offer. So why invest now? I just shared with you a couple minutes ago, we already have deals ready to go. So for the first 3 million raised, investors can actually come in at different classes with a lower minimum. So that top class, that A3, $350,000 minimum investment, that investor will get a 90-10 split. So any funds that are allocated to that class, to that investor, 90% will go to the investor, 10% will come to us as the manager. Now that class A2 minimum investment is 150,000. And the split is a little bit less, 85, 15, 85 to the investor, 15 to us. And then that class A1, and we can only take 5 investors because we're regulated on how many investors we can actually bring into this deal. So we can't load it up with a bunch of investors at 50,000. So that's why we can only have 5 at this time. And that's going to fill up probably within 48 hours or less. So that class A1, 50,000 minimum, that's an 80-20 split. Now, to give you an idea, and some of you have probably done quite a bit of due diligence and looked at other opportunities, you don't typically see splits like this for the investors. It's not uncommon to see maybe a 60-40, 60 to the investor, or maybe a 70-30. So we were intentionally very generous with these splits because we want to put the investor first. That's our focus at REV, is the investor. We focus on them so that we could create a good experience for them. Now, if you look on the right side of that table, the targeted returns, these are our conservative projections. And we got another slide that we'll talk more about. So in that top class, 14 to 16%, next 12 to 14, 10 to 12% average annual return. That's what we're projecting. So look to the right. If you decide to wait and invest later, that's okay. We'd still love to work with you. But as you can see, that minimum investment jumps up. So if somebody wants to come into that A3 class, it's now $500,000, it's 500,000. That A2 class is 250,000. And this A1 class is $100,000 to get those same splits. So again, we're really excited for this opportunity, and we expect this 3 million to be raised honestly within 1 to 2 weeks. I'm just being completely transparent. So if this is something you want to get involved in, let us know sooner than later so that you can take advantage of that. Fee disclosure, this is broken up in more detail in the pitch deck. I'm going to be as simple and quick with this as I can. So admin fee, the only fee, again, let me repeat, the only fee that we are charging for this fund is a one-time 2% fee on the money that's invested. That's it. It's not reoccurring. So the asset management fee, we don't have it. The asset management fee is typically an annual fee based on how much assets, how much funds are being managed. And that can range anywhere from 1% to 3%. We don't have it there. So again, the only fee was a one-time fee, 2% of the capital, committed capital or capital invested. So manager compensation, that's going to range anywhere from 10 to 20%, depending on what class you come in as an investor. And then the equity investors are going to be anywhere from 80 to 90%, again, depending on what class they come in. This is what I want you to understand of the breakdown here, okay? That 80, we'll say 80-20 split, okay, just for example, that's going to start immediately on any of the cash flow that comes into the fund. We still have a business to run. We got to keep lights on. It's very minimal, and it incentivizes us to perform and to help the other partners perform, because the better they do, the better we as a fund do, both you and us as the management team. So 80-20 split, any of the cash flow coming in on any capital event. So that's either a refinance of the property or a sale of the property where a large lump of cash is coming into the fund. You as the investor get 100% of that, 100% of that until you get your entire investment back. And it doesn't decrease your ownership in the deal. Our goal is to get you your capital back as soon as possible. So on any large capital event, you as the investor get 100% of the capital. We don't see any of it until you get all your capital back. Once you get all your capital back, then it resorts back to that 80-20 split or that 90-10 or whatever class that you fall into. So again, we don't have a lot of fees because our interests are aligned with yours. Our job is to help the fund perform at a peak state so that we collectively can reap the benefits of it. If we were charging all these fees, it wouldn't matter how the fund performed. And that just didn't sit right with us as a team. So no refinance fee, no disposition fee. Again, this is the structure we just felt aligned best with you as the investors, along with the splits that we were offering. Okay, so let's talk a little bit about projected returns. A lot of information on the slide. I encourage you to go back, process it, digest it. I'm just going to touch on a few items here, okay? And more so on the left side of this slide. So if you look at the top left, minimum class A3, it's a $500,000 investment. Unless you come in the first 3 million, then it's 350,000. We are conservatively projecting a 1.79 equity multiple with a 14% IRR with a total return of 79%. So if you go straight over to the right, you're going to see average annual return for this A3 class and an average cash on cash return. So the average annual return, we're projecting 15.8% for the investors that come in with a cash on cash of 5.6. That cash on cash is what you could expect year over year on your investment. Because we're forcing the value of these deals, the value is realized when you sell or you refinance that property. So again, I want to make sure that's clear. You can expect, and what we're sharing with investors, anywhere from 4 to 6% a year until that property sells or refis. And then when we dispose of all the assets and all those proceeds are factored in, then you're looking at an average of 15.8% for this A3 class. Same thing for A2. You can see the returns are adjusted a little bit, and that's due to the splits. This is an 85-15 split, not a 90-10 split. And again, if you were to come in the first 3 million, it's 150,000 minimum investment, not 250. So make sure you take advantage of this early incentive. And then you'll see class A1, you're looking at closer to 11.8% average annual return. Now, I want to iterate this. So listen, I hope you're listening, take some notes down. These are based on active deals that our team has been underwriting, that our team has been analyzing. So these are current deals with conservative projections. What this does not include is the additional upside that we negotiate with the operator to get a higher return, to get better returns that flow into the fund. When we negotiate those higher returns, it doesn't come to us exclusively to the manager. It flows into the fund and then it gets split dependent on what class you as an investor are in. So these returns that we're projecting don't include that. Is there a possibility and likelihood that we could exceed these? We feel so, but again, we want to set realistic expectations because of what's going on in the market. So it's important to understand our conservative approach to projecting these so that you understand the potential of the upside. And the way our deal is structured, the way this fund is structured, there's no limit to your upside. We don't cap it. We don't say, hey, you investor, once you hit 20% return, then we take the rest of it. We don't have any of that. It's a simple, straight split. So the better these deals perform, the better we all benefit from it. And that's why we're really excited to share this opportunity with you. So again, take time, look through this. It has projected what you could expect for projected cash flow in year 1, 2, 3, 4, and 5, return on member capital, and the net proceeds at the time of sale or refi. And so you can, again, take time in the pitch deck to look through that. Okay. So we talked about the operator, we talked about the markets, and we talked about the deals that we're getting involved in with the fund, and shared with you some of these projected returns. So what? Why does this all matter, and why and how can this benefit you? So this was an animation that we put together to really help people understand where we were coming from as a company. So I have 3 different scenarios here, okay? 3 different people, they have $100,000 and they know they want to invest in real estate. Scenario 1, this is what I would consider the solo route. Somebody has $100,000 and they put it into a single family home. A lot of people start here because they're comfortable with it. They understand it. A lot of people have bought a home before, so they're comfortable going this route. And I don't think it's a bad route. I think it's a good route because it's still a real estate and it's still an intangible asset. Here's the deal. Single family homes values are based on the market. We touched on that earlier. And if your tenant moves out and it takes you a month to renovate and then you got to lease it back up, or the HVAC system goes out, kiss your cash flow goodbye. So second scenario that I want to refer to is what I call a syndication. Now this is an investor takes $100,000, they pool it with other investors. Now these investors combine their sources of funds and they purchase a large commercial asset. In this case, let's say it's a 100-unit apartment building. So that same $100,000 is now not in one door, it's in, let's say, 100 doors, right? So that investment is diversified over 100 units. 10 people move out of that apartment, you're still 90% occupied. You're still 90% occupied. So the other tenants that are still living there, they're paying for the expenses. They're paying, making sure that cash flow is still being produced at the property. This is what I consider a much better option. And this is the 2 deals I shared with you, the Henriette Rosenberg and the Henriette Jones Road. Those were syndications. We like them. We like them. And this is what the fund will actually be participating in. That will make sense here in just a second. Third scenario, this is what we consider the best scenario, and this is a fund. So the way our fund is structured, investors will come in and will say, again, $100,000, you pool it together, just like the syndication, but instead of going into one deal, it gets diversified across multiple deals or multiple syndications. So what we do is we strategically vet operators, top operators in the top performing markets, and we partner with them on their deals so that we're able to diversify the funds within the fund at a much higher level than people can when they're doing syndications. So if one property, we'll say, is in Florida and gets hit by a hurricane, that's okay because we got deals in Arizona, we got deals in Texas, we got deals in the Carolinas that are still cash flowing. So it provides a higher level of diversification and risk mitigation that a lot of opportunities and vehicles just don't provide. And that's what we would consider to be the best vehicle to invest in real estate in these times. And this is what we are opening. and this is the opportunity that we're presenting to you. Okay, investment eligibility. I know we're probably over the 30 minutes. So I want to cruise through this. Again, our team is here for questions, so please ask. Okay, investment eligibility offering. It is a Reg D 506C, only available to accredited investors. We have some definitions of accredited investor there at the bottom right of the slide. Pause it if you want to read it. Options, we can do cash, IRAs, solo 401ks, QRPs, entities, trust, combination. If you have a retirement account or have other ways to invest and you're not sure if you're eligible, reach out to us, ask us, and we can have that conversation. Again, minimum investment for this offering is $100,000 unless you come in that first 3 million, and then those minimums apply as shown in the previous slide. Now, this is a first come, first serve investment opportunity. So no spot is guaranteed until the funds are received into the business account, into the LLC that you will be a partner of. So you decide this opportunity makes sense, you do your due diligence, you have a conversation with us, and you feel good about the investment. What's next? So review the opportunity. That's part of this webinar. Review the opportunity, have some conversations, and then set up an account in our portal. And there's going to be links. Just click on the link to start that process. Just because you commit an amount in the portal when you sign up, that doesn't mean that that's what you have to do. But it lets us know where you're at, and it reserves your spot. It doesn't guarantee your spot. After you do that, we need for this 506C, this isn't our rule, it's per the SEC, we need third-party verification of your accreditation. So some people already have an accreditation letter ready to go. If you're able to share that, we document it, we put it in our books, and you're good to go. If not, within our portal, there's a very, very efficient way to do it through parallel markets. And in fact, we had an investor do it not too long ago, and we got verification back same day. So no cost to you, very efficient, but we need that accreditation. So you make the commitment, you get your accreditation verification, and then you review the documents. And this is your private placement memorandum. This is the operating agreement. I'm going to tell you, it's about 100 pages of legal jargon. So if you have questions, feel free to reach out to our team. We could go through that with you. But once you sign those, then you fund, and wiring instructions will be available to you. And we expect those to come in within 3 days of those docs being signed. Let me be clear. If you're coming in on this early investor incentive, your spot isn't guaranteed until the funds are received into our account. So this entire process can be done in probably 3 days, I'd say on average. So just keep that in mind as you're preparing. And the more due diligence you do up front, the quicker it's going to be. But again, our team is here for you every step of the way. So you invest. You like the opportunity, you understand what we're doing as a team, you invest. Now what? What does that look like? Here's the deal. We are fully transparent. We need to be, we want to be transparent. We don't want people blindly investing with us. We want them to understand and know what is happening at our level so that they can feel comfortable and confident with their investment. Transparency is huge for us. For this reason, and because you're partners of the company, we are uploading monthly financials into the portal every single month of the fund performance. So you're going to see the profit and loss. You're going to see these important financial documents, and you'll know what we know because you are a partner of the company. Even though your role is a passive investor and you don't have decision-making abilities, you know what we know, and we're fully transparent on what we're doing. Communication is huge for me and my team. So with a fund, since we're going to be operated and involved in multiple deals, there's going to be a lot of stuff going on at every property that we're involved in. So we're going to be in direct communication with the partners and the teams that we're investing in. And what we'll do is once a month, we're going to host a monthly investor call. It will likely be 1 to 2 hours long. You can come in, they'll be recorded. You can come in, you cannot come in. Again, this is only for the investors that are working with us in this fund. And on that call, we're going to break down and update you on what's happening at every single property that we're involved in. And if there's other properties we're currently looking at, we're going to share those details with you as well. Just so, again, you know what we know, you're kept in the loop, and that communication is there. We also provide email and text updates as well. We'll do a lot of updates in the portal, so you'll always have access. And then our team is always here, again, to address any questions that you might have. Now, this is something I'm actually really excited about. We really enjoy building communities. For 2 years, we ran the largest apartment investing monthly gathering in the state of Arizona, and we loved it. Our last event we had a few months ago, we actually had over 150 people there, all looking to grow and to become involved in the apartment investing space. We really enjoy community. So a couple of things that we're doing for our investors that participate as well. One, we do investor-only events. In fact, a couple months ago, we did a large event up in Sedona where all of our investors came in. 2 days, we provided meals, beautiful hotel, Hilton Hotel in Sedona, and we just had a good time. We got to know each other. We connected with people face to face that we didn't have an opportunity to do so. So we're going to be doing that with our investors because it's more than just investing in growing and preserving your wealth. There's a community, there's a feel, there's something that we're really working on creating here at REV. And then what we're also going to be doing is property tours of the deals that the fund is invested in. So you as an investor can actually walk through the property. You can walk through the units and see what your investment is doing. So we will organize those. We'll let our investors know whether they can make it, whether they can't. That's completely up to them, but that option is going to be available. So again, we're super excited for this opportunity because it's such a great time to get into real estate. And I know some of you listening might not agree with that, but I'm telling you, like what you're seeing on the news, what you're seeing on social media, there's stuff happening. Don't get me wrong, right? But if you're taking a conservative approach, if you're connecting with a great team, it is a phenomenal time to get into real estate. So don't be like me when I fractured my leg. I kept telling myself, I'll get into real estate when? I'll get into real estate when? Well, guess what? I broke my leg. I was just about out of work. I didn't know how I was going to provide for my family. And I wish I got into real estate sooner. So I didn't let that happen this time around. All right. So stop telling yourself, I'll get into real estate when. If the opportunity is there, if you've liked what you've seen and you understand where we're coming from as a team, let's have a conversation. Let's get on a call and see if this really works for you, because we're really, really excited for this opportunity. And we've spent a few $100,000 just to bring this opportunity to you this evening. So a follow-up to the story that I shared with you as we wrap this up. I shared with you my situation of how I got started into real estate. Again, maybe some of you have lost jobs in the past. Maybe you've lost a loved one. Maybe you're just looking for tax benefits or to grow and preserve your wealth. Either way, you're watching this webinar and you're interested in this opportunity for a specific reason. I don't know exactly what that is until we have a conversation. But here's the deal. My decision back in 2017 that I made to get involved into real estate, let's fast forward 2 years. March 2020. We all know what happened during March 2020. I had just as much, if not more, of a traumatic incident where I was out mountain biking and actually went over my handlebars. And I came down on both my elbows, shattering them. 2 years previously, I just broke my leg. Now here I am in a mountain biking accident with 2 fractured elbows. But life was different. I was able to focus on my recovery. I didn't have the financial stress and worries that I had on that first incident because of that decision I decided to make to get into real estate 2 years prior. And this is why. 2 weeks before that accident, I sold that very first deal that I decided to purchase back in 2017. After I broke my leg and I said, hey, something's got to change. If this was to happen again, how am I going to take care of myself and my family? I got into real estate. 2 years later, we sell that property. 2 weeks later, I get into another serious accident, where if I had been working any other job, I wouldn't have been able to work. This time I was sitting on a lump of cash and I was able to provide for me and my family. Now, I hope none of you have to go through that. I hope none of you have gone through that, but some of you may have gone through similar situations. And maybe you haven't, and you're just looking again to free up your time, to be more available for your kids or to serve. I talked to an investor the other day that goes to Mexico multiple times a year to do dental work for free. And we're talking about working together because he's looking for someone to help manage and grow his wealth and preserve it so that he can continue to do that more frequently. This is why REV exists. This is why my team and I are so excited to bring this opportunity to you. And at the end of the day, our goal is to make apartment investing easy for you. It's a lot of work. There's a lot of moving parts that go into it, but that shouldn't prevent you from getting involved. So our goal is that you get to know us. You don't need to know everything about multifamily. We encourage you to learn about it, but at the end of the day, you don't need to know multifamily. You just need to know us and trust us to the extent to work with us and partner with us on these deals. We're on this journey and we're inviting you to come along with us. So folks, again, thank you for your time this evening. I know we went over the 30 minutes, but hopefully you got a lot of information from the opportunity, and we want to talk to you. We as a team want to answer your questions. So please go through, review the pitch deck. We expect questions and things to come up, and let's schedule a call. A link to schedule a call and a link to invest, if you're ready, will be available for you. So do that as soon as possible, especially so you can take advantage of the early investor incentive, assuming it's still there. But we want to anticipate that within the next few weeks. So again, folks, thank you so much. Click on the link to start the investment process. And if you have additional questions, we look forward to answering those with you, and we look forward to doing some deals with you. We'll talk soon.